But what happens is this, Vince, the minute one employer that's self-funded for the first time, they got 300 lives. The minute they have a $300,000 claim where they're thinking their spec is 50 and they're not being reimbursed 250,000, guess what they're doing? They're never self-funded again. They're going back to fully insured. So all the amazing things that we've done over the past 20 years just go away because we're not looking at this as a way to help our industry as a whole. It's a few bad apples out there that are ruining for the rest of us.
Hey everybody, Vince Lewis, Vice President of Sales at Partners MGU, welcoming you to the latest edition of the Partners Podcast. On this edition of the podcast, I had the privilege of chatting with a name that's pretty well known in self-funded circles, Adam Russo, the co-founder and Chief Executive Officer of the Phia Group. Our discussion covered a wide range of subjects relevant to our industry. In fact, because of the wealth of knowledge he has, we talked about so much that we're releasing this edition in 4 episodes. The first episode is titled The Biggest Differences in Stop Loss. So when I was preparing for this episode, I was reminded of a meeting I had with a prospective producer a couple of years ago. I questioned him, and when I questioned him on the stop loss markets, he explained that they had no allegiance to any one carrier, as they felt that stop loss was quote unquote a commodity product. You can change carriers anytime with no distinct difference between one carrier, one stop loss provider, and another. I don't know if I was more shocked by the comment itself or this particular broker's ignorance. But one thing we do know is that not all stop loss providers are the same. And the biggest difference more often than not is in the stop loss policy itself. For example, is the plan mirroring provisions in the policy actually plan mirroring at all? Or how is experimental and investigational treatment explained? What about potential gray areas like reference-based pricing and vendor fees? More often than not, as you will know, these challenges don't even really manifest themselves until there's an actual claim. In this segment, I'll talk about what I feel is the big lie concerning stop loss. Adam will comment on the biggest mistake that brokers and consultants make in reviewing and comparing stop loss policies. Want to guess what the biggest challenge is? When he told me, I found it to be actually quite shocking, and I'll leave that for the podcast for you guys to listen to. But very rarely does this thing actually happen when folks review their stop loss policies. Anyway, I hope you enjoy this. To listen to the full conversation, please click on the link in the description. And tune in next week for our next episode on how COVID-19 impacts stop loss claims. We'll see you again soon. Please feel free to comment. We'd love to hear what you all have to say. Thanks.
Hey, hello everybody out there. Welcome to another edition of the Partners MGU podcast. Today we have a super special guest. I'm super pumped, super excited. The man, the legend, Adam Russo of the Phia Group is here to join us. This was a major get for us. So Adam, welcome to the program. Thanks for joining us, man. It's an honor.
I'm honored to be here, especially your organization. You guys have been a great organization to work with over all these years. And I'm a loyal person. I believe in growing this industry, and I believe in doing everything I can to help my friends, partners in the industry succeed and thrive, and you're one of them. So I'm glad to be here.
There are probably like 4 main issues I want to cover with you. Primarily, one is stop loss contracts.
Yep. What's a stop loss contract?
Yeah, well, that's a good question, right? This day and age. I mean, so that'd be the first thing. I mean, in politics, everyone wants to talk about what's known as the big lie, right? I mean, but we're not going to talk about politics today.
No, talk about the big lie. Bring up the big lie with stop loss. Yeah.
But there is a big lie as it relates to stop loss insurance, and that to me is that all policies, all stop loss providers are created equal. We're just this commoditized product that everybody can just interchangeably shift in and shift out and that sort of thing. But there really is a difference, especially as it comes to contracts. So I'm kind of curious in what you guys do at Phia. What do you see are the biggest challenges or biggest differences in stop loss contracts and in terms of major areas of difference, I guess, and what should plan sponsors, brokers be looking out for when they review contracts, if they review contracts at all?
Biggest challenge is getting people to read them. Read the
Right,
policy.
like I said.
I mean, that's it. I mean, put it this way, Vince. One day when I grow up, right, when I become a big guy, right, when I finally make it to the big top, the major leagues, I'm gonna start my own stop loss company, and it's gonna be called Phia Stop Loss. Okay.
All right.
And what I'm gonna do is I'm gonna have the cheapest premiums on earth. So if everyone else is 100,000, 150, 200, 300, mine will be 20 grand. Okay. It's gonna be so cheap, everyone's gonna buy it. But here's the thing. Instead of a 10-page policy, it's going to be a 1-page policy or maybe 2.
Okay.
And what I'm going to do on page 2, not on page 1, they might read page 1 by accident, but on page 2, I'm going to have one exclusion and I'm going to highlight it. I'm going to in yellow. I'm going to put like glitter on it. I'm going to make it a 30 font. I'm going to bold it. And it's going to say, we will never reimburse a claim.
Okay.
And I will sell so many policies because people don't read them. They just look at the price. And the bottom line fact, folks, is this. You know, I have seen, my company, Phia, has seen every type of stop loss policy there is. If you're not realizing that there's exclusion provisions in there is language in there that literally would make it that you, as the plan, have to pay the claim based on the terms of your plan doc. But the stop loss carrier does not have to reimburse you. They don't have to reimburse at all. They specifically say in that situation, they won't reimburse. Now, that might be fine for you, but at least you would know what that risk is. Most people assume that when they buy a stop loss policy, if they pay it and it's over spec, it gets reimbursed. And the number of calls, I would say, and I'm putting guns in my head, I'm guessing here, but I would say at least 20, we deal with at least 20 situations a week that deal with this.
Wow.
And even those companies that say we mirror the plan, we've seen some organizations use mirroring as a way to not reimburse a claim too. Because what happens is they'll say is, well, the plan isn't following the terms of the plan. Hence, we're not going to reimburse the claim. So I would say you have to read the policy, but I would say almost as important is understand the behavior of the stop loss carrier that you're working with or the MGU that you're working with. Do they have this attitude in their claim shop of deny first? Right? That's the thing. So you want to work with the right organization, and you guys are one of those organizations. I mean, that's the bottom line. I would not be doing this call with you guys if I thought that your policy is one that's ruining the self-funded industry. But there are stop loss policies out there that because they're so bad and because they're not being reimbursed, and I get it, the stop loss carrier does not have to reimburse. But what happens is this, Vince, the minute one employer that's self-funded for the first time, they got 300 lives. The minute they have a $300,000 claim where they're thinking their spec is 50 and they're not being reimbursed 250,000, guess what they're doing? They're never self-funded again. They're going back to fully insured. So all the amazing things that we've done over the past 20 years just go away because we're not looking at this as a way to help our industry as a whole. It's a few bad apples out there that are ruining it for the rest of us. So all I would say to you listeners out there, read your stop loss policies. And if your exclusion section is more than a page, I've seen something like 4 pages, maybe don't sign it. And if you see a stop loss policy premium that's, 30%, 40% cheaper than all the other ones, there might be a reason for that too.
Right. Ask
So
questions.
it's not just the price. You got to look at, will they actually reimburse? Is it a solid organization? And are they truly a partner or are they a vendor?
To your point, each policy has different provisions, different exclusions, different everything. So to your point, the broker or the plan sponsor has to review the policy, and each one is going to stand out differently than another. If they read it, then they'll know, right? They're educated.
I'm guessing that 10% of them are read. I really mean that. Because and I'm sorry if we're going too far on this point.
No.
We've even had situations where we have told a TPA or a broker, listen, my friend, here's the language in the policy, right? You see this provision? If they wanted to, they could actually make an argument to never reimburse any claim if they just chose not to. So you better be careful, especially near the end of that stop loss year. If they decide to go to somewhere else, they're not going to pay that claim back. So we advise them. Oh, and also, Vince, by the way, guess what else?
What else?
By the way, right now at our company, I'm just making this part up, but this actually happens. Right now, that same carrier, that same stop loss carrier, is doing what I'm telling you to 10 other TPAs across the country, and they're being sued by 4 of them.
Wow.
Are you really sure you want to partner with these guys?
Wow.
And even after all that, Vince, they still do it. And why? It's cheap.
Hi, everybody. Vince Lewis with Partners MGU, welcoming you to another edition of the Partners Podcast. In part 2 of our 4-part discussion with Adam Russo of the Phia Group, we continue our dialogue on a variety of subjects related to the self-funded industry. This segment addresses the COVID-19 epidemic and its impact on brokers, carriers, and insurers. In this segment, there are a couple key things that should be noted from Adam's comments. First, the concept of deferred utilization that most of us in the industry knew was inevitable from COVID. Of course, there are a lot of surgeries and elective procedures that have or will take place that were now on the tail end, now that we're at the tail end of the pandemic. But there's an emotional toll that has happened that will create spikes in mental health and drug addiction claims and the related treatments. Now, what I'm really curious to see is what the fourth quarter of 2021 will bring as far as claim frequency and severity. At Partners, our own book of business has shown significant increases in claim activity in the last 3 months of a plan year, which, situation in some instances where you see a case that when you sold it was profitable, by the end of the plan year ends up taking a loss. So you couple that with some of the crazy things that I've seen in pricing from stop loss carriers, we could be looking at a lot of potential upheaval this time next year. Just a thought. The second challenge is how brokers are protecting their self-funded clients from potential COVID claim exposure. This becomes even more critical when considering various state workers' compensation laws related to COVID. Is your plan document and claim procedures in line to avoid unnecessary exposure? Remember, the carriers only pay what the plan document says. The tighter the PD language, the less the carriers have to interpret. Adam has some great insight on this topic. To listen to our full conversation, please click on the link in the description. And please let us know your thoughts and comments surrounding the segment. We also hope you check in next week for our episode 3 on how surprise billing impacts reference-based pricing. We hope you enjoy.
So couple that with the policy. You mentioned some earlier about claims practices of various stop loss providers as well. So, what in your, you kind of touched on it a little bit, but in your capacity at Phia, what are you seeing? What are you experiencing in terms of claim mindset and behavior of stop loss providers out there?
We know, just based on the fact that we get all the claims data from all of our clients, right? We get every claim. Claims volume was down big time last year. Mm-hmm. Overall, if you were a self-funded plan, even if you did nothing, no innovation, no cool plan design, no change in behavior, people weren't going to get treated. So hence, You had a great year. Man, this self-funded thing is awesome. Yeah, because they're telling you can't leave the basement, bro. It's going to change. So we saw that a lot of our clients had amazing experiences when it came to what they paid in claims, right? It was a great year.
Right.
But what they weren't talking about was the fact that people weren't getting preventive treatment. So cancer screenings, things like that.
Right.
So what we saw was stop loss carriers, rightfully so. When I went to, we have stop loss and we went to get renewal, we looked at all these different quotes, et cetera, and everyone was trying to increase the rates by 10, 15%. And I'm sitting there going, what?
How's this?
We had no claims last year.
Right. What's up with that?
You had a great year last year too, stop loss carrier. Right. How can you do this to us? And I heard the same thing with every carrier I talked to. Adam, we're freaked out what's going to happen later on this year. all those people that either delayed, postponed, or never got a treatment,
Right.
guess what's going to happen? That cancer that they could have caught at the beginning when it was cheap to catch, they're not catching it now. Now you got an operation. Now you have complications. Now you have big surgeries. Now you have what you guys love to call in the industry, catastrophic claims.
Right. Right.
So that's why, right? People are seeing, I mean, when we look at the trends now, even, we're definitely seeing an uptick, but there's no question that the big concern is what's going to happen in that fourth quarter, right?
Yep.
Are people going to then start having these surgeries? What's going to happen there? And then you also have to look at a couple other things, if you don't mind, Vince, if I just keep on going.
No, please go ahead.
You know, mental health.
Right.
The increase in the number of people that are on antidepressant medication. Listen, the drug companies are psyched.
Right.
But you have people now who prior to COVID weren't on medication, and now they're going to be on it for the rest of their lives. Drug addiction, alcohol use. Have you seen how much more alcohol is being consumed? So at least here in Boston, you still can't go to a bar. There's no nightclubs. How are they selling more alcohol than they did before COVID?
What they got, Uber Eats and DoorDash for liquor now, I heard.
Listen, man, people are sitting in their basement and just opening up bottles.
Yep.
So that's going to have an effect not only on a person's health claims, but also on an employer. Those people work for you, right?
Yep.
So you got behavioral health issues, you have potential, drug addiction issues. Everything we're noticing, people weren't getting that preventive care. So from a claim standpoint and a patient behavior standpoint, there are things that we're trying to help people fix. And our webinars have been talking about that. Like, we know that there are still 30% of all plans don't have within their plan documents anything on telemedicine, telehealth. Everyone is doing it virtual now, right? I mean, we all have.
Right.
And we're still seeing that such a big percentage of self-funded plans, maybe they thought COVID was going to go away after 2 weeks. Remember last March, right? Like, oh, yeah, by the summer we'll be fine, right?
Right.
It's been a year, man. I've been on a plane in 13 months. So,
Yep.
But for whatever reason, many plans just thought this was going to go away, and they still haven't updated their plan documents as they need to, whether it's required because of COVID or just based on the patient behavior that I just talked about.
So the thing is, too, is that you spoke about mental health claims. What are those people going to do? They're going to go to rehab, right? Eventually, they're going to go to rehab.
Out of network, bro. Out of network claims. Those rehabilitation claims are the biggest ones that kill plans, right? That's where you see the biggest fraud. That's where you see the biggest abuse, are those claims. And typically, they're out of network. So again, what are people doing in regards to their language in their plan doc when it comes to reasonable and customary? What's allowable? What's the maximum allowable? And if I'm a stop loss carrier, those things are concerning to me too. In addition, COVID claims, COVID-related claims, workers' compensation. So I don't know about your organization, Vince, but what we have seen, we started scrubbing COVID data, COVID claims, starting in last May. When the codes came out, right, the diagnosis codes, procedure codes, we started scrubbing.
Right.
And what we do is we identify individuals who have COVID-related claims, are sick, right, or in the hospital, whatever.
Right.
And they are an employee of a plan. And that plan, we've identified that plan as being why am I forgetting it? An essential plan, that the person would be known as an essential worker, right? Work at a supermarket, at a fire department, hospital. So we're able to identify those individuals without ever contacting them. So we identify who those people are. And then based on what state you're in, workers' comp is primary. I don't know if you knew that. So out of all 50 states, I would say there are about 13, 14 states where if I'm working at a supermarket,
and I get COVID,
if I'm in New York, it's automatically assumed that I got COVID from work.
Yep.
Workers' comp pays.
Yep.
My job would have to prove that I didn't get it at work. Whereas you have another 30 states where it's the exact opposite, where I would have to prove that I did get sick because of work. Carriers don't know this. No stop loss carriers aren't looking at this. So what we have noticed is anytime there's a COVID-related claim, they're automatically pushing back on a plan saying, this person looks like they got COVID. Were they working? Are they an essential health worker? What does their employee handbook say? I'm like, dude, They're in California. It doesn't matter. They're not
Right.
going to get reimbursed by workers' comp. And it's just educational pieces that are, and again, it's all new,
Right.
but that's a huge trending issue that we're seeing now where we see a lot of plans paying a lot of claims in a lot of states that workers' comp should be paying. And no one's
Wow.
talking about it except for us.
And obviously, in order to combat against that, the plan sponsor needs to probably put in some sort of provision in their plan doc to make up for that difference, I would assume. Then,
Yeah,
right?
and not even just a provision, also a process. You need a process. What are you going to do? I mean, are they looking at those claims at all? So it's more than just language in the plan. It's also changing the claim process within an organization, the TPA or whoever the administrator is.
Hey everybody, I'm Vincent Lewis with Partners MGU, welcoming you to another edition of the Partners Podcast. In part 3 of our 4-part discussion with Adam Russo of the Phia Group, we continue our dialogue on a variety of subjects related to the self-funded industry. For those of you who are involved in reference-based pricing plans, you'll definitely want to tune in for this one. On this segment, we're addressing the hot button topic of surprise billing and reference-based pricing and its impact. I recently had a producer reach out to me in a huge dilemma. The reference-based pricing program he had just put in place for his client this past January now had to convert back to a conventional PPO program just a few months in. Why, you ask? Because the employer was tired of employees complaining of balanced billing from the local provider or requesting cash payment up front before beginning treatment. At best, this creates a morale issue for employees, but I've seen these situations play out in the media as a public relations nightmare. Balanced billing has been the thorn in the side of self-funded employers and their consultants who work for them. It's always been my opinion that reference-based pricing, or RBP, is really the first iteration of where our industry should be headed, and that is to a form eventually of direct negotiation on hospital bills. As Adam says, it's really just a different way to pay a claim. But negotiation proves difficult when there's never a level playing field. According to Adam, while Medicare pricing is considered the benchmark or reference point in RBP, most hospitals don't even take Medicare rates into consideration at all when determining payment. Surprised? And while Adam speaks of the challenges surrounding the topic, there's also, however, opportunity, especially with the new healthcare transparency rules in play. The question, however, is can the healthcare industry ever provide care for patients that is consonant with the price they charge? My colleague Bill Hoyt recently did a LinkedIn segment using the analogy of buying jewelry at a discount, but not knowing if the price was actually marked up to start with. And then you have the whole quality of care issue. It's the only industry I know of in which you get treatment, but you don't get something, a service, but you don't even know what you're getting until the price comes. It's enough to make your head spin. To listen to our full conversation, please click on the link in the description. And please let us know your thoughts and comments around the segment. We also hope you check in next week for our final episode in this series, The Impact of the American Rescue Plan Act. We hope you enjoy it.
Yeah.
Well, yeah, that's enough in and of itself. I mean, so let's stay on the COVID track for a minute, because I mean, there's a lot of stuff to unbundle from that. I mean, not only that, but you got other issues. You got the whole thing with surprise billing that's going on.
Dude, I mean, you and I could talk about surprise billing for 5 hours, man.
Right.
I mean,
right.
I'm being straight up. I mean, with surprise billing, all right, as an example, and I hope you don't mind that we're going like this way.
No, please, let's do it, man. No, for sure.
But surprise billing, reference-based pricing plans are freaked out. A lot of people are freaked out. They're thinking, is it the end of reference-based pricing? I look at it the opposite way. I think this is a huge opportunity for people, because now, again, the definition of what a surprise bill is, people still don't understand. It's a surprise. Like, that's the point.
Right.
So at the end of the day, a lot of the things that we have been dealing with and seeing across our industry when it comes to balance billing, et cetera, that's still going to continue.
Right.
It's only not going to continue when it's a actual surprise. So if you're doing reference-based pricing, we're noticing more and more vendors out there, more and more RBP plans, direct contracting, right?
Mm-hmm.
Making deals.
Right.
And I see RBP eventually becoming an RBP network. All reference-based pricing is a different way to pay a claim.
Right.
Instead of taking a discount off a charge, it's just adding a percentage to Medicare.
Right.
But the weird part about surprise billing is, and I don't know if you knew this, they don't take into consideration Medicare rates at all when they try to figure out what the right payment amount is. So Medicare is the biggest payer to every hospital in the country.
Sure.
Yet the amount that Medicare pays to a hospital, when you have an arbitration process, right? You can't come up with a deal, right? The plan and the facility. They don't take Medicare pricing into account when they're trying to figure out a fair and reasonable price at all. It's going to be based on, obviously, what's their average network rate? What do they typically get from a Blue Cross or a Cigna, whatever. So, but I think there are huge opportunities when it comes to surprise billing for the self-funded industry. No different than when Obamacare came out. I mean, Vince, I don't know if you remember when Obamacare came out, how many TPAs thought their lives were over?
Like,
it's
done.
It
was a wrap. Yep. I remember
how many TPAs sold out, thinking that that's it.
Consolidation. Yep.
And I used to stand in front of audiences and go, dude, this is the best thing that's ever happened to our industry. Because now, for the first time, employers actually have to care about healthcare.
Mm-hmm.
Like, the government's forcing you to. So we're being forced to care about the cost. You can't just not cover people.
Right.
So now there's more opportunity for us. Same here. This is the ability for us to have transparency. But the problem, my friend, and I'm going to ask you a basic question, right? If I came to you and I said, hey, Vince, I got a $50,000 car here and a $100,000 car here. You can pick either car you want. Which one has a better quality?
You would assume, based upon the price of the $100,000 car.
And that's the problem with transparency in healthcare.
Right.
We both know, most of our listeners, your listeners, hopefully we know, price does not equate to quality in healthcare.
Exactly.
Because a hospital charges $100,000 for this surgery and another one charges 10, it doesn't mean the $101,000 one has better quality.
Right.
And that's the problem. So even though we have all these transparency out there tied to surprise billing, all this stuff is now transparency. You still don't know the quality. Imagine going on Amazon and only being able to see the price of a TV, but not the quality of the TV, the ratings.
Yeah, it's the only industry I know of. Yeah, it's the only industry I know of where you're paying for something that you don't know what you're getting what the end product is going to look like.
Right. So at the end of the day, that's the one area that as an industry we need to do a better job on, is with surprise billing, with the end of that, with all these transparency rules coming into place where people have to be prices are posted, etc. It could hurt our industry if all people see our prices.
Right.
Because if anything, you're actually getting hospitals to say, I should just charge more. So if I charge more, they'll think we're better.
Right.
And that's what scares me.
Hey everybody, Vince Lewis with Partners MGU, welcoming you to another edition of the Partners Podcast. In our final episode of this 4-part series with Adam Russo of the Phia Group, we continue our dialogue on a variety of current subjects related to the self-funded industry. This episode discusses the American Rescue Plan Act, which was passed earlier this year, that among other things, carries some provisions that can have potential impact for both self-funded plans and in turn stop-loss providers. Now, to be honest with you, I hadn't paid a lot of attention to the act in terms of the insurance aspect until I got a call from one of my brokers asking how we plan on handling the COBRA premium subsidy language in the law. So when I began to research the language, the more concerned I got. In essence, qualifying employers are required to offer 100% subsidized COBRA continuation coverage from April through September of this year to what are called assistance eligible individuals, or AEIs for short, at no charge in premium to the individual. The employer in turn is offered a tax credit against their payroll taxes. Problem is, that act extends COBRA continuation to individuals prior to April of this year, even if they had declined coverage previously. Now, this creates a significant anti-selection risk for the employer and the carrier. Now, some folks think more often than not these AEIs these folks won't even read the election notice letter that comes in the mail. But all it takes, as you know, is one person to elect coverage and then have some kind of procedure, or at worst, develop complications to create some huge claim that could have devastating impact. It's like Adam said, once you get it, you can't take it away. Adam and I do agree on several things though. You have to keep up with ways to control costs to prevent exposure through constant review of claims data, cost containment programs, and plan document review and amendments. And in case you were wondering, we at Partners follow all federal guidelines regarding COBRA as they are revised, explained, expanded, I should say, relaxed, or whatever, due to the impact of COVID. If a member is reinstated, claims from that individual will be deemed eligible, barring any other determining factors. To listen to our full conversation, please click on the link in the description. Thanks for watching. We'll see you next time.
There are a lot of things that have spurned from COVID that are really challenging, I think, to how we're going to be able to move going forward. Like one thing, like this recently passed American Rescue Plan Act. I know they're supposed to come out with some guidelines and directions on how that's supposed to work, start, I think, tomorrow. But I mean, this whole thing with COBRA continuation coverage, it's really, the more I hear about it, the more I'm like, how's this going to work for employers? It just seems like it's going to be another Pandora's box.
Remember when 10 years ago, you had you could be 20, if you were 22 years old or 23 years old, you couldn't be on your parents' plan, right?
Yeah, that was a long time ago, though.
Right?
What you're saying, right?
And as you know, and I'll be honest, right? I like the getting rid of the pre-existing condition exclusion. That to me is morally important. Like,
sure,
because you're sick. I mean, the whole point is, shouldn't we be helping the people that are sick, not hurting them? So
right.
I get that. But the minute you give people something, my kids, all right, hey kids, look at this. This is called a phone. And you can go online and look at YouTube.
Yeah.
Try to take that phone away afterwards. It's no different with this. The minute people get something, right or wrong, good luck trying to take it away.
Yep.
There is zero chance from a political standpoint or even an ethical standpoint, moral standpoint, that you'll ever go back to you're allowed to deny someone coverage because of a pre-existing condition.
Yep.
It's going to be nearly impossible to go back to, oh, you're 25, you're just smoking weed all day in your parents' basement? No worries. You're not covered under the plan. That's never,
right.
Those
That's
days are over.
Happen. Yeah, exactly.
So the minute you give, it's hard to take away. And what I've seen, and I know you have seen, especially in the stop loss world, the minute they got rid of lifetime maximums.
Right.
Remember when every claim somehow was under $1 million?
Yep, exactly. Yep.
How all of a sudden are there $5 million claims, $10 million claims, $30 million claims?
Yep. So
you're telling me with COVID, the costs won't continue to stay high? Not talking about the patients,
right.
the employees. I'm talking about the employers. They're going to eat these costs.
Yep.
And people say, well, in the fully insured world, they don't. Yeah, you do. You're paying more premium. Trust me. So the point is, the concerning point I have is, unless we have a situation where instead of the focus being on giving everything to everybody, sure, give everything to everybody, but have a plan in place of how you're going to contain those costs so that you're not going to see this just explosion continue to occur. And that's my fear. I just see these costs going up, especially because of this. I mean, if it's answer me this question, I want to ask you a question.
Okay.
If it's related to COVID, right? Has to be, if it's related. What's the definition of a treatment related to COVID? So what if, I break my leg? I'm just throwing out an example.
Right.
It's a slippery slope. Coverage issues related to COVID, I can see every hospital appealing any claim that's denied and say, hey, it's this is tied to COVID. It is? How? And they'll find a way. So I'm just weary of just these continuous changes. And you realize that every time one of these changes comes in play, you got to update that plan, doc, too.
Yeah.
And that's more money being spent. Well, that's good for me, I guess.
Well, yeah, because I was going to say, because that was going to be my question. Like for stuff like this, I mean, with this act, I mean, basically you've created an inherent selection risk. A person could come back, from last year and say, you know what, I should go get that surgery now or whatever. and hey, next thing you know, it could be something. It could develop. The person could go in for a minor surgery, develop sepsis, right, and get super sick, and then ring up
Right.
a whole bunch of money. So then you have this huge claim on your hands. But like you said, like updating the plan doc is probably the best way for an employer to protect themselves against these possibly unforeseen situations.
If you're a broker right now and you have not had a conversation, if you're an employer right now and you have not had a conversation with your broker about what's going to change in 2021 versus 2020, you better fire that broker.
Yeah.
The bottom line is this: you need to make sure you're real understanding. Yeah, great. You had a great year last year. Claims haven't spiked. Those things I mentioned at the beginning of this conversation, you need to look at your claims data and your employee behavior and see what are you doing to address what's going on in the country today. Telemedicine, rehabilitation facilities. Are you even auditing your pharmacy spend? Like,
Yeah.
it's through the roof.
That's huge, right? That's huge.
These are things that people need to do that they weren't doing in prior years. But I can tell you, there are so many employers and brokers right now who are doing this. They're patting themselves on the back because 2020 was an awesome year,
right,
from a claim standpoint.
Yep. Exactly.
So that's the concern.